Hi everyone, this is Knowledge Topper, and in this video we will discuss about one of the most important liquidity ratios, and that is the current ratio. We are basically covering the series of financial ratios. So this is one of the videos of our financial ratios series. You will understand this with the help of an example as always. So more importantly, your concept should be clear. You can watch all other financial ratios videos by clicking the link in the description of this video. But before moving towards the main, if you didn't subscribe to our channel Knowledge Topper yet, please do subscribe our channel Knowledge Topper as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So first of all, we will look at what current ratio is. Then we will further discuss about current ratio in detail, and at the end we will solve an example as well. So your concept should be clear more importantly. So as written on your screen, the current ratio is a measure of a firm's ability to pay off its current liabilities with its current assets. The current ratio is a type of liquidity ratio. Current ratio is an important measure of liquidity because current liabilities are due within the next year. Current assets like cash and cash equivalents and marketable securities can easily be converted into cash in such a short span of time. Like when you talk about this statement like current assets like cash, cash equivalents and marketable securities can easily be converted into cash in such a short span of time, it generally means like that a company has a limited amount of time in order to raise the funds to pay for these liabilities. This also means like that companies with a larger amount of current assets will more easily be able to pay off its current liabilities when they become due without having to sell off long-term revenues generating assets. Okay. So basically, in short, if we talk about current ratio, it is basically a measure of firm's ability to pay off its current liabilities with its current assets. Okay. The current ratio is calculating by dividing current assets by current liabilities. I will show you the formula. So here is a formula for you guys. As you can see, current assets divided by current liabilities. It is one of the most simplest formula in financial ratios, and you can easily remember this formula as well. So at this stage, there might be a question will rise in your mind, like what basically this current ratio tells, like what is the purpose of this current ratio. So this current ratio basically helps investors and creditors to understand the liquidity of a company, and it tells how easily that company will be able to pay off its current liabilities. This ratio basically expresses a firm's current debt in terms of its current assets. Suppose that the current ratio of a company turns out to be 4, so it means that the company has 4 times more current assets than its current liabilities, and a higher current ratio is always more favorable than a lower current ratio, because it shows the company can more easily make its current debt payments. Let's take it to the other way. Now suppose if a company needed to sell off fixed assets to pay for its current liabilities. Now this usually means that the company's current assets isn't making enough from its operations, from its current operations, okay, to support its activities. In other words, you can say that the company is losing money. Sometimes this is basically the result of poor collections of accounts receivable as well. Company makes huge amount of sales, but these sales are on credit basis, like on accounts receivable basis. So that's why company faces liquidity issues, because there is not enough cash for company to pay off its current liabilities. Okay. So the current ratio basically it also sheds light on the overall debt burden of the company. Like if a company is weighted down with a current debt, its cash flow will also suffer as well. Now let's jump to our example that I prepare for you guys. So here's an example and how you can calculate current ratio. So as written on your screen, ABC Skate Shop sells ice skating equipment to local hockey teams. Okay, ABC is applying for loans to help fund his dream of building an indoor skate rink. ABC's bank assets for his balance sheet so they can analyze his current debt levels. According to ABC's balance sheet, he reported 1 lakh of current liabilities and only 25,000 of its current assets. So ABC's current ratio would be calculated like this. As you can see, $25,000 divided by $1,000. As you can see the formula, like our formula is basically current assets upon current liabilities. So we just extract the important information from the question and just put our values in the formula. So as you can see here, the current liabilities is $1 lakh. So here is $1 lakh and our current assets is $25,000. So we will put $25,000 in our formula. So while we calculate this, the answer turns out to be 0.25. So what basically this answer tells is like ABC only has enough current assets to pay off its 25% of his current liabilities. Like this shows that ABC is highly leveraged and highly risky company, because like banks would prefer a current ratio of at least 1 or more than 1 or 2, so that all the current liabilities would be covered by these current assets. Okay, now since as you can see ABC's ratio is so low, it turns out to be 0.25, and banks would prefer a current ratio of at least 1. So it is unlikely that ABC will get approved for his loan. So as you can also see the importance of this current ratio, like almost all financial institutions use current ratios to decide whether they want to give loans to company or not. So when companies applying for loan, the financial institution is more looking towards company's current ratio, because it tells the liquidity of a firm. It tells a firm's ability to pay off its current liabilities with its current assets. So this is the video for all of you guys. Hope you understand clearly about the current ratio. If you like this video, thumbs up. Do subscribe to our channel Knowledge Topper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. In our next upcoming videos, we will cover other financial ratios like quick ratios, debt to equity ratios, return on assets, and return on equities as well, and other more important financial ratios. So if you want to watch that, you can just click the link in the description of this video. Okay, so this is the video for all of you guys. Thank you so much everyone. It's time to say bye bye.